November 8, 1890. At the Bank of England in London, William Litterdale had served as governor for 3 years. Yet nothing during that period had prepared him for the document waiting on his desk at 6 o'clock in the morning. The message came from Lord Revelstoke, Edward Baring, the senior partner of Baring's Bank. It was the most respected merchant bank on earth, the institution that had funded the Louisiana Purchase, supported the Napoleonic Wars, and helped finance infrastructure projects across much of the known world. Its contents were alarming. Baring's was insolvent, not illiquid. Insolvent. The difference was critical. A bank facing illiquidity possesses sound assets that cannot be sold quickly enough. An insolvent bank holds assets whose value is lower than its obligations. During the previous decade, Barings had directed vast amounts of British capital into Argentine railroads, Argentine sovereign debt, and land development ventures throughout Argentina. The strategy appeared entirely rational while Argentina's economy was expanding at 8% per year. It became far less rational after the Argentine currency collapsed, the government defaulted, and the Buenos Aires water supply and drainage company proved to be worth far less than investors had assumed. By November of 1890, Barings controlled approximately $21 million in Argentine and Uruguayan securities. Those securities were almost impossible to sell. The bank's capital base stood at $7 million. The mathematics required no complicated interpretation. Litterdale had 72 hours to choose between allowing the world's most famous bank to collapse or arranging a rescue effort unlike anything attempted before at that scale. He chose intervention. Over a single weekend, he brought together every major British bank, leading merchant houses, and the governments of France and Russia. Together they assembled a $17 million guarantee fund. The immediate panic subsided. Barings underwent restructuring. Financial contagion was contained. Yet the underlying process that created the disaster remained untouched. A global power had watched its financial institutions become heavily exposed to debt assets whose value depended on a growth narrative that could not continue indefinitely. That process was not eliminated. It would eventually return on a scale measured in hundreds of trillions of dollars. Financial history often describes the Baring crisis as the first modern financial crisis. It marked the first occasion when excessive exposure to foreign debt by a single institution threatened worldwide systemic contagion. What many accounts fail to emphasize is the reason it happened. That reason connects directly to 2025. Barings did not collapse because of simple recklessness. It failed because it operated within a structural environment that rewarded one particular behavior for years. Then the environment changed. The very behavior that had generated profits for decades suddenly became the source of catastrophic losses. Britain in the 1880s was producing enormous capital surpluses. Its industrial economy had matured. Investment opportunities at home no longer delivered the returns enjoyed by earlier generations. The excess capital needed a destination. Argentina appeared to offer exactly that. Argentine bonds paid between 6 and 7% at a time, when British consols yielded only 3%. Argentine land values rose at rates that made English property seem ordinary by comparison. The expansion was genuine. Railways were under construction. Cities were growing. Agricultural exports were surging. Less visible from London was the debt structure supporting that growth. Argentina was borrowing in order to expand, rather than expanding in order to support existing debt. Provincial authorities issued bonds backed by future land revenues. Infrastructure firms were funded using projections of future traffic that had not yet appeared. The entire growth model relied on leverage. Future income streams were being pledged to present-day lenders before those revenues actually existed. As long as growth continued at the expected pace, the leverage remained manageable. Once growth slowed, the entire structure unraveled far more quickly than anyone in London had anticipated. Barings stood at the center of the flow between British investors and Argentine borrowing. When the foundation of that investment story ceased to hold, the bank was left carrying the concentrated remnants of 10 years of transactions. Now consider America in 2025. The comparison requires precision because the similarity is not the one most observers focus on. The most visible connection is debt. United States federal debt stands at $36 trillion. Corporate debt totals $13 trillion. Unfunded entitlement commitments add between $50 trillion and $80 trillion in present value obligations. Using any straightforward calculation, the combined total exceeds $100 trillion. These figures are significant. Yet the real parallel with Barings is not chiefly the amount of debt. It concerns the structure of ownership and the narrative attached to those assets. For 8 decades, foreign central banks and large institutional investors have owned United States Treasury securities under a particular belief system. They accepted that American debt carried no meaningful risk. They accepted that the dollar was the unquestioned reserve currency. They accepted that the fiscal foundation supporting those securities remained solid and that the political framework could continue sustaining it. The attraction was never merely a 4% return. The appeal came from the institutional narrative itself. It was the same type of narrative that drew British investors toward Argentine bonds during the 1880s. Strong credibility, acceptable returns, the most trusted name available in the marketplace. The Moody's downgrade of November 2024 did not alter the mathematics of American debt. Those numbers had been visible for a long time. What changed was the institutional narrative. It was comparable to a credit analyst in 1889 publishing a report showing Argentine government revenues expanding at 4%, while debt servicing costs were rising at 9%. The facts themselves were already known. The formal recognition was new. Now consider the crucial development. Foreign ownership of United States Treasury securities reached a peak of approximately $8.3 trillion during 2022. By the middle of 2024, when that figure had fallen to roughly $7.9 trillion, this was not a wave of panic liquidation. It was a measured reallocation. The same type of gradual repositioning that occurred before the Barings crisis, when experienced investors in London quietly reduced their Argentine exposure. Publicly, Buenos Aires continued to be described as the Paris of South America. Privately, positions were already changing. A liquidation involving more than $100 trillion does not occur in a single day. It does not happen in a single week. It unfolds as a process. That process begins when the distance between the institutional narrative and the underlying arithmetic becomes too large for sophisticated investors to overlook. The mechanism that transforms a gradual shift into a crisis is the reason the Barings comparison centers on intermediaries, rather than debt totals alone. Barings was more than a lender connected to Argentina. It served as the channel through which British capital reached Argentine borrowers. It transformed Argentine risk into instruments that British investors could purchase, assess, and trust. When Barings collapsed, the consequence extended far beyond the loss of a single institution. The trust framework supporting British ownership of Argentine assets disappeared with it. Without Barings, investors no longer had a credible intermediary. There was no widely trusted evaluator of value. There was no dependable market maker prepared to temporarily absorb those assets. The liquidation that followed did not stop with Barings' own holdings. It spread across the entire category of Argentine assets that British investors had accepted because Barings had endorsed them. The United States Treasury market possesses its own equivalents to Barings. Primary dealers serve that role. Money market funds serve that role. Foreign exchange reserve managers serve that role as well. Together, they have acted as trusted intermediaries connecting global capital to American sovereign debt. Their ability to continue operating as dependable buyers rests on confidence in the institutional narrative. Once confidence in that narrative weakens, those intermediaries confront the same position Barings faced in 1889. These institutions continue to hold assets whose future worth depends on a narrative that is becoming increasingly difficult to maintain. The immediate vulnerability lies in the refinancing schedule. In 2025, the United States must refinance approximately $9 trillion of maturing debt. That process requires investors willing to purchase newly issued securities at prevailing yields. If the marginal buyer becomes less willing to participate, yields must rise in order to attract demand. Higher yields increase interest expenses. Greater interest expenses expand the deficit. A larger deficit requires additional debt issuance. More issuance, combined with higher yields, creates an arithmetic pattern structurally similar to the one seen when Argentine provincial governments issued bonds in 1888 against revenues that ultimately never appeared. The significance extends far beyond the borders of the United States. The Barings crisis demonstrated a global contagion mechanism for the first time. The modern financial system has recreated that mechanism on a scale William Litterdale could scarcely have imagined. When Barings collapsed, the effects spread through Buenos Aires, Montevideo, London, Paris, and New York at the same time. British capital had become the dominant source of funding for emerging market development around the world. As that capital retreated, every project and market supported by it felt the consequences. The crisis was not solely British. It was not solely Argentine. It became global because the capital being withdrawn had been deployed globally. United States Treasury securities now occupy a similar position within the modern financial system. They serve as the foundational safe asset for central banks, pension funds, insurance companies, and money market funds across the world. They also function as collateral, supporting a vast share of international financial transactions. When that collateral is repriced, the effects move through every system that relies on Treasury securities as a benchmark. Mortgage rates are affected. Corporate borrowing costs are affected. The discount rates used by pension funds to calculate future obligations are affected. Ultimately, all of them are anchored to yields on United States Treasury securities. When Barings was rescued in 1890, Litterdale was not saving only a single institution. He was preserving the broader structure of British financial intermediation throughout global markets. The Federal Reserve's implicit role in the Treasury market serves as the modern counterpart. Its willingness to purchase Treasury securities whenever private demand proves insufficient mirrors the function of Litterdale's rescue effort. The challenge raised by a potential $100 trillion liquidation is whether such a rescue can occur at the required scale without generating inflation that would itself represent a form of default. The warning signs do not arrive through a letter delivered on a Sunday morning. Litterdale received 72 hours because the message reached him before markets opened. A $100 trillion liquidation emerges differently. It appears through gradual changes in Treasury auction demand. It appears through steadily increasing term premiums. It appears through central bank reserve reports showing reduced dollar holdings. It appears in the language of the Moody's downgrade, expressing the same concern in more formal terms. The Bearing crisis did not begin with a sudden shock. It emerged from the steady buildup of a structural imbalance until the gap could no longer be managed. The rescue succeeded in 1890 because that gap was identified before it became self-reinforcing. The question facing 2025 is whether the difference between what American sovereign debt represents and what global investors have been told it represents remains at the stage of 1889, or whether it has already advanced to November 1890. The liquidation process has already started. What remains uncertain is the speed at which it unfolds. If this analysis gave you a new perspective on the connection between historical financial crises and modern sovereign debt markets, share your thoughts and continue following the discussion as the story develops.